Company Wakefit Innovations is set to launch its initial public offering on December 8th, comprising of a fresh issue of shares worth around 377 crores and an offer for sale of around 4.67 crore shares. Ritu caught up with the management. Listen in to a slice of that conversation.
I think when Ankit and I started about 10 years ago, we were both failed entrepreneurs. So every learning that has happened has been by following customers and what they wanted.
Yeah.
So if you really ask me about 2 or 3 inflection points, the first is we pioneered the 100-day trial policy for our mattresses so that customers could take it, try it in the privacy of their home, decide whether they like it or not.
Yeah.
The second big thing was to look at a true omni-channel experience.
Yeah.
So we were a purely online company, which is available on marketplaces and our D2C website. But about 3 years ago, we ventured offline in company-owned, company-operated stores. That really gave a great experience to consumer. And our philosophy of educating them before they buy was a very big thing to be done offline.
Okay.
So these two were something that's very important for us.
And then what a way you've come. But, in this IPO, if you could give us some specifics. Your initial DRHP that you filed in June spoke about a 460-odd crore primary issue. That amount is now reduced as per your updated DRHP?
Yeah, the primary has reduced a tad bit because we had a pre-IPO transaction.
Yeah.
And we also changed some of the objects of the IPO. But it is a small reduction, barely about 30-40 crore. You will see the specifics in the document. But the overall size of the deal has increased because of the pre-IPO demand.
About the IPO, before we move on, both you and Ankit are also selling shareholders in the OFS. You're offloading about 12.8 million shares together. What kind of message is that going to send to investors? What would you want to tell them about how invested you are in the growth story?
I think more than the specifics of that, what is more important is that post the listing, we both still own a significant amount of company. I think it's closer to 35% if my memory is right. So we are here for the long haul. We have built it for the last 10, 11 years. My third venture, Ankit's second venture. For us, Wakefit has been our life's work till now. It's a very small portion given that it is a liquidity event after so long. But we want to continue doing this for a while.
Let's also talk about the proceeds because a large portion is going towards, 1, your offline expansion and 2, your marketing expenses. I mean, rather than say, looking to build your digital channels or invest into the factories. So, what is the sort of thinking there? What are you trying to achieve?
Every company goes through its phases of different investments in different parts of its life cycle. So we have the Greenfield project that you see here. It's one of the largest furniture factories in India. So during that period, a lot of the company's investments went there. Today, as it is scaling up, we need to invest in marketing. But as a company, we've always invested very frugally. In the last few years, marketing has been between 8 and 12% of the overall revenue. So we've been very frugal, make sure that the company customer acquisition cost is low, repeat is very high. And so we've never been a company that's reliant on marketing for survival. It's necessary, you do it. So even that, if you look at the amount that we have put in the IPO proceeds, it still amounts to the same 8 to 10% kind of a range. It's very, very sustainable as a company.
So, how do you project payback from the kind of investments you're making? Your losses have widened this year from the previous year to about 35 crores. What would you guide investors? I mean, while your losses have come down over the years, how soon before Wakefit is a fully profitable company?
So out of the 9 odd years that when we filed the DRHP, about 7 of them were profitable, EBITDA and PAT positive. The 2 years that we did go into losses was because of the huge investments we made into the Greenfield project. That was never existing in India itself by any company. So today we've reduced that completely. And you will see that even in the coming years, we will continue to focus on structural efficiency, ensuring that we are very, very frugal. So you'll see us, even when the full year financials come out, you will see that things will continue to improve.
Okay, let's talk about your omni-channel strategy because you're spending a lot of energy into going offline as well. You have about 130 odd stores already. What is the plan over the next few years? What is an ideal mix for the company post-IPO?
The plan is to continue to open stores, but it is always going to be calibrated. We don't take a store opening target because that is a wrong incentive to give to the retail team. In your hurry, you will choose the wrong micro markets, you will choose the wrong building because you're trying to achieve a target. So what we want to do is open a steady 3 to 5 stores every month, make sure that they pay off very well. The payback period is very low, and you choose the right place, right building.
Yeah.
So that is the target. So it's not to open a X number of stores. In terms of the mix, we are not going to be measuring ourselves on that. We are going to be measuring ourselves on the own channel revenue.
Okay.
Because own channel would mean our D2C website and our stores put together.
Yeah.
Because consumers research anywhere, browse anywhere, purchase anywhere.
Yeah.
So we cannot just say that I will not be present here or I will drive transactions to a particular channel.
Yeah.
But what we do measure is as an integrated number of store plus D2C website, that should be large.
Yeah.
As of the DRHP time, that number was 55%.
Yeah.
Which means where our reliance on marketplaces is less.
Yeah.
Post that, if you look at the full year financials, that have gotten better. I'll be able to talk about the specifics once the RHP is filed.
Of course.
But that's improved even further.
What about the revenue mix as for products? You know, for instance, you started out with mattresses. That is more than 60% of your revenues. Then there's home furnishing and there's furniture. How will this mix evolve? I mean, what do you think are the fastest engines of growth for the company in the future?
Mattress has been our mainstay.
Yeah.
Like you rightly said, it's about 60%, but it's still growing in double digits. But furniture, given the small base effect, is growing way faster than mattress.
Okay.
So mattress continues to be a strong pillar, and it's a great way to acquire customers where they had the first experience of Wakefit, trusted, have a really, really good thing to share with their family, friends, and they become advocates. And then furniture comes into their life.
Okay.
That's the plan. And so if we don't foresee this to be one or the other, the flywheel is running because customers come back for more products. So that's why all of them will grow, but furniture is definitely growing way faster given that it's a smaller base.
But could you give us a sense of what the mix would look like, say, 5 years down the line? Would 5 years be 60%? Home furnishing is, I think, 11%.
You're right. Mattress today is about 60%. Maybe 5 years. 5 years is too far out.
Yeah.
3 years out, we think mattresses would drop down to about 55%.
Well, that is the management of IPO-bound Wakefit with our colleague. Now, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.